Thank you very much. Good afternoon, everyone. It's my pleasure to be here in front of you presenting this research, and I would really like to thank RBA to have allowed me to present this and organizing this conference so that people can share the finding of different research and try to see how we can move together forward. So now, my topic is on. My paper is on bank concentration, competition, and financial stability in Rwanda. And as said, my name is Christian Yarihama from Research Department at National Bank of Rwanda. So, okay. Now, being from the regulatory side, I would like really to start with this important information. This is a disclaimer, so that the views I will express here are just mine and do not necessarily represent the views of National Bank of Rwanda. So this is important to mention. Yeah. Now, this is the outline. I will not dwell on that for long, and I will start by research questions. So, as my topic is a little bit self-explanatory, the question we sought to answer in this research is to, first of all, to assess how competition have been evolving in the banking sector in Rwanda. Here, we focused on the competition within the banking sector, not the competition between banks and fintech, as Eric was presenting before me. And secondly, we wanted to assess how concentration and competition would affect banking stability in Rwanda. Concentration and competition, of course, are two related concepts, but different. Sometimes they are confused, but they are different concepts I was explaining in the presentation. And lastly, we wanted to look at how concentration and competition would affect bank efficiency in Rwanda. So, okay, going back in the motivation, I should have started by the motivation, but let me try to motivate the reason behind this study. We know that, okay, from the common knowledge is that competition is beneficial for many reasons, including mostly social welfare, because competition fosters innovation, fosters productivity, and in particular for the banking sector, competition can be good for, let's say, allowing more, better customer service and let's say more customer choice if you are giving more, you are providing more product or diversified product to the customers. But also it can bring efficiency or foster efficiency in the banking sector. Or in overall, the common knowledge is that competition is good for industry. Yeah. But again, we know that most of the time when there is competition, in first competition, sometimes some players can be eliminated and others can thrive after, because in one way it can, let's say, take the customers of those players who have been eliminated. But the issue is, banking sector is a particular industry. Why? Because contrary to other industry, in another industry where you eliminate one player and you can remain with customers, in banking it's different because banks are interlinked and interconnected. When one bank is facing distress, it immediately affects other banks because they have common assets. They do lend to each other. They do process payment and payment from one bank to another. So in the banking sector, the situation is different because if one or several banks are facing distress, it immediately negatively affects other banks. Again, we know that from the experience from the recent financial crisis or other financial crises which have happened, that banks are usually prone to contagion. When bank is facing distress, it affects others. And again, it's an industry which relies on public trust. When one bank is having distress and the public trust, start to doubt about maybe the solvency of the stability of that bank, it will even affect those which are stable in that industry. So that's why the banking industry is different. And when we think about the advantage of competition, we should pay attention, especially when it is about the banking industry. So, and knowing that also that banking industry or stability of the banking sector is really vital for the healthy economy, given the role banks play in the economy. This is not a debate. We know that banks allow better financial intermediation, payments, and business growth and doing business. This is really common knowledge now. So now, coming back on the issue of competition in the banking system, in the literature, there have been a lot of research on this issue. And the big issue is that the literature is not yet really have not yet reached the consensus, because we have like two competing hypotheses. On one side, you have what you can call competition fragility hypothesis, where some authors, like here I can cite the Allen Gate paper in 2004, which is one of the famous papers in this area, where they show that when banks have market power, when competition, the competition can be detrimental to banking sector stability. Why? Because they say that when banks have market power, this would enhance their profitability and caution against potential distress. Secondly, they say that if banks have more market power, they have a charter value to protect, and this will reduce incentive for risk-taking. But that's one hypothesis. And some of the papers which have been following, empirical papers in for different country cases, they have tend to confirm this, that competition will lead to bank fragility instead of stability. On the other side, another theoretical paper by Bode and Donicolo in 2005 supported this competition stability hypothesis. So meaning that for them, competition in banking sector will enhance stability. Why? Because they say if banks have more market power, they have power to charge higher rates, take more risk, and at the end affect borrowers in a negative way. And when borrowers default, and that will affect the stability of the banking system. Secondly, another argument is that competition will reduce credit rationing, because normally they say, okay, if banks are trying to compete, they will be more, willing to rent to the economy, and that will allow the economy to thrive, and at the end they will bring positive effects, even on the side of stability of banking system. And again, they argue with this phenomenon called too big to fail, where banks, some of the big banks know that the regulator, the government will not allow them to fail, and they say that if bank has market power, they will take more hazard, more risk, and eventually knowing that they have that insurance of getting bailed out. So they support that it's better to have competition so that to ensure stability. So this is on the literature side. Now, coming back on our cases in Rwanda, we know that, and even many presenters ahead of me, like Jared in the morning and Christian and Eric, showed clearly how the banking system have been really growing in a substantial way in Rwanda. Here you can see how on the chart above how the asset of banking sector have been growing. Even the rapid of recent, we are seeing that the growth is even more rapid than the past. Again, if you try to compare the total asset of banking sector to GDP, you see that we have an upward trend, meaning that in total asset of banks are in one way increasing more than the GDP, even though it's a stock and flow comparison. But again, it's a good indicator that we're having really a strong growth in the banking sector in Rwanda. And again, we are having, the profitability of banking sector is really improving. If you look at the chart below, we have return on asset, return on equity on the secondary axis. These numbers are not normally crossed like this, but one is on the left axis, as you can see. And now, on return on equity in 2024, we have reached 20%, which is really a very encouraging, let's say, performance. Again, at the same time, we are seeing some diversification in the products or services offered by bank and pricing. And my colleagues have talked about it, how we are having many products in the banking sector. And even on the regulatory side, from National Bank of Rwanda, so we are having some regulation. In the past, we had regulations to try to ensure banking system stability, especially I'm talking about these Basel regulations. But at the same time, we do have regulations to try to to foster market conduct and consumer protection, which enhance transparency in one way, but also can enhance competition. So we do have many things going on, and it's important to look at these dynamics and see, and in light with what I talked about this lack of consensus in the theory regarding the effect of competition stability, it's important here to assess the situation of Rwanda, to look at the implication of these dynamics we are seeing here in Rwanda and how they would affect banking system stability. So now quickly on the methodology, I will not spend more time on this because, okay, this is just an approach I used. We use this data from mostly balance sheet and income statement and FSIs from banks. And we also looked at some macro data, like capital GDP, inflation, and exchange rate. And our approach was to first try to derive some of the indicators, because there are some agreed upon indicators of competition in the banking market. This is RENA index and edge statistics. We had to derive them because we have to use data from balance sheet and income statements to try to derive these indicators. We also looked at had to also derive on the proxy of banking system stability, because stability is a broader concept. But what we use here is the Z-score. Z-score is usually used in the literature because it combines both profitability and the solvency of banking system, and also consider the volatility in the profitability of banking system. Here, you can either use return on asset or return on equity. And we also looked at some indicators of banking sector performance, like the cost efficiency, operation efficiency, and bank lending. So we did estimate different models, mostly panel data, because we used the bank level data using GMM so that you can address endogeneity issues to try to answer the research question I talked about at the beginning of the presentation. Now, looking at the key finding, that's where I want to spend more time. Starting with some of the indicators we derived, especially the indicator of competition in the banking system and the stability in the banking system. On the upper chart, here we try to compare the Z-score, which is the indicator of banking system stability, and the RENA index, which is the indicator of competition. An increase in the RENA index meaning less competition, because the RENA index is just, we compare the average price of banking product with the marginal cost from the Econ 101. So, and if the difference is getting bigger, it means that banks have more market power to price above the margin cost. And this indicates that competition is reducing. So, starting with the competition, we can see that the RENA index is going up over time. This is the darker blue line. And what does it mean is that we are seeing a decline in competition in the banking sector. Maybe some bankers here may disagree with me because, they say, we are facing tough competition now. But what maybe can be more can explain more this this chart below, where I try to compare the average price and the marginal costs. The input I use to calculate this RENA index is that, as you can see, the marginal costs in the banking sector have been really going down over time. In the same time, average prices of banking products, even though they have declined around 2021, now they are flat. So what does it mean is that marginal costs are going down, but prices are not following as much as maybe they could have been following in an environment where there is tough competition. So that's the explanation. Secondly, it's just a global indicator of competition, and we know that our market is segmented. In some segment of the market, especially for corporate or other big borrowers, we know that the competition is tough, but also in the same time, for the remaining borrowers, we know that the competition is not really coming up as maybe we would wish. So again, maybe one of the important, let's say, this to mention here is we tried also to do a simple correlation analysis, looking at concentration and competition, how they are related, just a correlation. Because as I mentioned at the beginning, concentration and competition are two different concepts. Concentration is more about the number of players and the share they have on the market, while competition is the ability to price above the marginal cost, the ability to dictate prices on the market, let's say. So maybe the good thing we can mention here is that concentration and competition, even though they do have a positive correlation, but this correlation is not strong. So keeping in mind that we have seen that of recent, we have seen concentration increasing in bank market in Rwanda due to some bank measures which have happened, that it doesn't mean that necessarily, even if banks are consolidating, it will imply that they will have more market power, maybe to overcharge the clients. So this is really a very encouraging result. So now, quickly on the other key findings is that now on the quick question, do market competition affect stability in a negative way or in a positive way? So the main result is that in Rwanda, having some market power to price above margin costs is good for stability in the banking system. So, but this positive relationship between market power and stability in the banking system is not linear. So we should also insist on that, because if you try to check with a square, I mean to assess, to do an equation where you include the square of the Lerner index as indicator of competition, you see that this relationship is not linear. So even if market power is good for stability, more market power will negatively affect stability. So excessive market power is not good for stability, but some market power is good for stability. Quickly, on concentration, we see that also concentration can be detrimental to the market system stability, especially when it is combined with the market power. But concentration aside is good for stability also. So quickly on regarding bank efficiencies, that contrary to what we would expect, is that market power is associated with higher bank efficiency in Rwanda, and again, market power is associated with higher increase in bank lending. So on the policy application, maybe quickly, and what we can get from this research is that market power, even though market power boosts banking system soundness, we should keep in mind that excessive market power can be detrimental. So we should be monitoring how competition is evolving in the banking system, especially when the environment is favoring some bank concentration. And again, there is a synergy between market conduct and consumer protection and again, bank stability, because sometimes people may think that trying to push for more customer protection would affect banking system profitability, but this is not the case. So you can see that there can be a synergy between trying to protect borrowers, but again, ensuring that banking system is stable. And quickly on main takeaways, sorry for taking more time. First is that market power, the ability to price above the marginal costs, boosts profitability and caution against potential distress. That's fine. But again, keep in mind that excessive market power with higher lending can lead to some distress in the system. So there is a need, the main message is that there is to strike a balance. Strike a balance. Of course, if you have market power, you can price above the marginal costs to boost your profitability, but keeping in mind that trying to maybe to price higher because maybe there is some demand and people are desperate to get loans can at the end lead to some distress in the banking system. So there needs to strike a balance, and the key is to reduce costs, to have some cost efficiency, so that you can, even if competition is there, you can really be able to compete and ensure your stability. Thank you very much.